A stock that closed at $1.43 in July 2016 closed at $197 in July 2026. That is a total return of 13,701%. A company that bet on a problem before the problem existed and then waited for the world to catch up. So, where's the high watermark? Three engineers founded Nvidia in 1993 with a conviction that the PC would one day demand dedicated chips for 3D graphics. The GeForce 256, marketed as the world's first GPU, shipped in 1999. That same year, Nvidia went public at a split-adjusted 25 cents a share. Revenue was $374 million, almost entirely from gaming. In 2006, Nvidia released CUDA, a software platform that let developers write standard C code for its GPUs, turning a graphics chip into a general-purpose parallel processor. The bet was expensive. Nvidia had to add hardware features, build a compiler, maintain libraries, and teach a generation of programmers a new way of thinking. Wall Street saw it as a distraction. Inside universities and research labs, something was stirring. In 2012, a team at the University of Toronto used two Nvidia GTX 580 GPUs to train a deep neural network called AlexNet. It crushed the ImageNet visual recognition challenge, and the modern AI era began. Almost every breakthrough that followed ran on Nvidia hardware. By 2017, Jensen Huang was ready to declare it openly. Standing on the GTC keynote stage, he said, and I'm quoting, "The era of AI has begun." The financial world was beginning to notice, but the first wave of explosive growth came not from AI, but from an entirely different kind of digital gold. The week of November 6, 2016, the stock rose 30.2% to close at $2.20. The catalyst was fiscal Q3 earnings. Revenue hit $2 billion, up 54% year over year, driven by a doubling of data center revenue. The market began to reprice Nvidia as something more than a cyclical gaming play. 6 months later, another volcanic week. The stock surged 23% to close at $3.20. Nvidia reported fiscal Q1 revenue of $1.94 billion, up 48%, and guided for $1.95 billion the next quarter, signaling the data center boom was accelerating. The stock had now quadrupled in less than 2 years, but there was a third, less savory engine beneath the hood: cryptocurrency mining. The same parallel processors that excelled at training neural networks were also perfectly suited to solving the cryptographic puzzles that secured blockchain networks like Ethereum. Miners bought every GPU they could find, creating a shadow demand that Nvidia could not fully quantify. The party ended in the fall of 2018. The week of November 11th, Nvidia fell 20.1% to $4.11. The real damage was the guidance, $2.7 billion expected for Q4, well below the $3.4 billion consensus. The culprit was a classic inventory glut. The crypto boom had collapsed, and the channel was stuffed with unsold cards. On the conference call, Jensen Huang did not mince words. He said, and I'm quoting, "The crypto hangover lasted longer than we expected. The Fed was raising rates, trade tensions with China were escalating, and the stock fell 44% over the quarter. Amid the gloom, a fleeting bounce. The week of March 13th brought a 19.7% gain to $26.45, driven by a bullish Cowen note on Nvidia's growth runway. It was a head-fake rally. The true bottom was still 7 months away. Three forces hit at once. 1. The pandemic-era gaming boom ended. Gaming revenue fell 44% sequentially as consumers stopped buying GPUs. 2. On October 7th, the U.S. government imposed sweeping export restrictions on advanced semiconductors to China, targeting Nvidia's A100 and GPUs, a $400 million revenue risk. 3. The Fed's aggressive rate hikes crushed valuations. Nvidia's forward PE compressed from over 60 to under 30. If 2018 was a crack, 2022 was a near-death experience. The stock peaked at $32.98 on November 14, 2021, then ground lower for 11 months, bottoming at $11.23 on October 9, 2022, a 66% drawdown. There was no single-week crash. The stock simply bled lower. The bottom, when it came, was quiet. The stock closed at $11.23 on October 9th, and no one rang a bell. But less than 2 months later, on November 30th, 2022, OpenAI released ChatGPT, and the world changed. Demand went from zero to insatiable in weeks. The real shock came on May 24th, 2023. Nvidia reported Q1 revenue of $7.19 billion, beating estimates, then guided for $11 billion next quarter, nearly 50% above consensus. It was the largest guidance raise in company history. The stock surged 25% to $38.95, regaining the November 2021 peak in a single day. The 18-month drawdown was over. Jensen Huang framed the stakes that day. He said, and I'm quoting, "$1 trillion of installed global data center infrastructure will transition from general purpose to accelerated computing as companies race to apply generative AI into every product, service, and business process." By 2025, the stock had become a barometer for geopolitical risk. In the first quarter, the stock fell 30.6% as fears mounted that AI capital spending was unsustainable. A Chinese startup, DeepSeek, released a model that appeared to match Western performance with a fraction of the GPUs. Then Trump announced sweeping Liberation Day tariffs on April 2nd. The week of April 6th brought a 17.6% surge to $110.93, after the administration announced a 90-day pause on most reciprocal tariffs, cutting many to 10%. The relief rally underscored how geopolitical risk now dominated the stock's daily swings. By mid-2026, Nvidia has become the most valuable company on Earth, its market capitalization exceeding $5 trillion. Data center revenue in the most recent fiscal year topped $100 billion, up from $15 billion just 3 years earlier. The CUDA ecosystem, with over 4 million developers, has become a moat as wide as any in business. Yet the open question is whether the AI build-out can continue at this pace. Every hyperscaler is spending tens of billions on Nvidia hardware, but AI application revenue remains a fraction of that. If the build it and they will come thesis falters, Nvidia could face its first true cyclical downturn since the crypto crash. For now, it is priced for perfection, a compound annual growth rate of 63.6%. And that's where the line stands.